The significant divergence between gold and silver, even though silver is, doing well year to date, did well on the week, it's still below its high price from 2020, where silver got above $35. So we're getting close to taking out that 2020 high. But what's significant is that gold is 50% higher than it was at its peak in 2020. Now, I think that's unprecedented. I haven't really, gone and looked at the history, but I'm pretty sure that there's not another period in time where the price of gold rose by 50% and the price of silver went down. That is a really weird anomaly that you're not going to see, because there is a high correlation even today, between gold and silver, very highly correlated. But to have a time period where gold rises by 50% and silver goes down, that really highlights how abnormal this situation is. And again, I think it's because the main buyers of gold are the central banks, and the retail public that would normally be buying silver, they're not active. They're selling. They're selling gold, they're selling silver, and some of them are buying crypto. But this really highlights how great the opportunity is in silver. I think gold's cheap too, but I think silver is a hell of a lot cheaper. And people, I think, should be focusing a lot of their precious metals firepower on silver, because I think it is going to catch up and get to where it needs to be when we start to get retail investors coming in. They're still missing in action. They still don't get it. And what I hear a lot of people say, the young people, they're buying crypto, so you should do what the young people are doing because they represent the future. They don't represent the future in that respect. Yes, the young people are the future, but when they're older, they're going to be smarter and they're going to be more experienced and they're going to have more wisdom. The idea that we should follow the investment advice of kids is farcical. I'd rather follow the lead of the central bankers. A lot of investors, when they look at the market, they look at insider buying and selling, right? Why do you want to look and see what the insiders are doing? Well, because they generally have better information. They have a really good feel for the company. And so if you see insiders dumping stock in the company, that would make you think about, maybe I shouldn't buy it, or if I own it, what do they know? Obviously, they know a lot. They know more than I do. They work at the company. So if they're selling the stock, maybe you should sell yours. If they're buying the stock, if you see a lot of insiders buying, that could be evidence of, hey, maybe, they must know something good's going to happen. Otherwise, they wouldn't be buying, right? So insiders buying and selling is considered a pretty good indicator of whether or not you should be buying, because they have the best information and they know the most about the company and have the best feel for its future prospects. Well, what's going on with central bankers buying gold? That's really like inside information on the fiat monetary system, because they're at the heart of it. They're the insiders. The central bankers are the insiders of the fiat monetary system. And buying gold is like selling stock, because they're selling dollars. So if foreign central banks don't want dollars, don't want treasuries, are willing to give up the 4% yield to buy gold that has no yield, that's a very strong indication that you should be doing the same thing. You should be following the lead of the central bankers, not millennials who are still living in their parents' basements. What the hell do they know? The guys that are at the heart of the fiat monetary system have a much better handle on what's going on. So you see the insiders in the fiat system dumping their fiat, dumping their dollars. They're not buying Bitcoin, they are buying gold. Now, they're also not buying silver. That is the opportunity for the retail investor to buy that silver. They're not buying it, not because they're not bullish, they just don't have a place to put it, right? That's not the monetary asset that they want, but the retail investor should be buying. People should be calling up Schiff Gold, get on the phone tonight, fill up your shopping cart. Silver is going to explode. I hear people saying, gold, it's bearish. Look, it couldn't hold 3,000. It went above it once. You would obviously expect in a big week, gold up over 2.5%, that somebody would take profits at 3,000. It doesn't surprise me that there was some profit taking at $3,000 gold. What's a good indicator is that it even traded above 3,000, and the fact that it ended the week as strong as it did, and the fact that silver outperformed. But also, I like the fact that now we're getting the gold and silver mining stocks outperforming. The GDX was up 6% on the week. That's the senior miners.
Look, if you really want to understand the financial world right now, you have to start with the simple fact that most people, from Wall Street to the average kid day trading on a Robinhood app in his parents' basement, fundamentally misunderstand money. They don't get it. They think money is paper. They think money is a number in their brokerage app, or maybe a fancy digital token, like Bitcoin. They don't realize that all these things are actually claims, promises, IOUs, ultimately dependent on trust in governments that are historically bankrupt both financially and, frankly, morally. Gold is money. It's been money for thousands of years. Gold doesn't default. Gold doesn't need a central bank press conference or a quarterly earnings call. It doesn't dilute itself. It doesn't suddenly vanish because some developer on GitHub forgot to update the code. It just is. Always was. Always will be. When your grandparents or great-grandparents talked about money having value, they meant something like gold. Not this system we have now, where a piece of paper in your wallet is called a dollar, but in reality is just a government debt instrument backed by the promise to dilute its own purchasing power whenever it becomes politically expedient. Now, if you look at the history, it's crystal clear. The US dollar was literally defined by gold. The Coinage Act of 1792 laid it out plain as day. A dollar was 24.75 grains of pure gold. Over time, that was roughly $20 per ounce, and that stayed remarkably stable for over a century. Even when we created the Federal Reserve in 1913, and boy, that was the beginning of the end, the dollar was still pegged at about $20 an ounce. Then Roosevelt came along. In 1933, he didn't just tweak things. He confiscated gold from American citizens under Executive Order 610-2, paying them $20.67 per ounce, then promptly revalued gold to $35 an ounce. Instant devaluation of the dollar. A wealth transfer on a massive scale from the public to the government. Now your dollar bought a lot less gold. In modern language, your savings got rug pulled. But the biggest break came under Nixon in 1971. Faced with massive spending from the Vietnam War and the Great Society welfare programs, plus runaway deficits, Nixon did the politically easy thing. He temporarily suspended the dollar's convertibility into gold. That's like saying you're going on a temporary diet that never ends. Since then, the dollar's value in gold terms has collapsed by over 98%. Today, you need more than $3,300 to buy what $20 did back then. Meanwhile, gold didn't change. It's still the same gold. An ounce is an ounce. What changed was the purchasing power of the paper dollars chasing it. And it's going to keep changing because our deficits are only getting more monstrous. Even with all the fiscal promises coming out of DC, all the talk of reducing spending, or fiscal responsibility, the reality is that the so-called big, beautiful bipartisan bills just make the deficit problem even worse. They slash revenues with tax cuts, jack up outlays with more spending, and then slap a red, white, and blue bow on the entire thing. The latest CBO projections? We're looking at average annual deficits of $2.6 trillion for the next decade, pushing US debt to nearly $50 trillion. That's not theoretical. That's their baseline. And every time you add a crisis or a recession, which is inevitable, those numbers get even uglier. Now here's the kicker. Most people still aren't paying attention. The American public is off buying meme stocks. They're piling into Tesla or Nvidia with options that expire worthless. Or they're trying to get rich quick on crypto because that's what they've been told is the modern hedge against inflation. Newsflash, it's not. Bitcoin isn't gold. It's not even close. Bitcoin is a speculative tech asset masquerading as money. It has zero intrinsic value, no yield, no utility outside of hoping someone else buys it from you later at a higher price. And don't get me started on the idea that we should be taking our cues from the 20-somethings on TikTok. Sure, the young are the future, but they're also, by definition, the most inexperienced investors on the planet. You wouldn't take brain surgery advice from a 23-year-old who just watched a YouTube video. Why take investment advice from them either? Investing is one of the few arenas where age, scars, and bitter lessons are advantages.
I think that's going to be more obvious because if this is a bear market in the NASDAQ and not a correction, right? A bear market is down 20%. And if the NASDAQ goes down 20%, Bitcoin's going way down. Bitcoin's going to go down, double. Bitcoin's going to be, a lot below maybe 65,000 at a minimum, which means it'll be less than Michael Saylor's average cost for all the Bitcoin he's leveraged up to buy. But if the NASDAQ is in a bear market, if you look at the last 3 NASDAQ bear markets, the big one was in 2001, right? Following the tech bubble. NASDAQ almost dropped 80%. During the bear market in the 2008 global financial crisis, the NASDAQ was down 55%. And in the recent, very abbreviated COVID bear market in 2020, the NASDAQ was down 30%. Right? So the average of those 3 is actually 55%. So if this is going to be an average bear market and it goes down 55%, where the hell is Bitcoin going to go? I mean, it's going to get decimated. It's going to get obliterated. And not just this price, but the whole narrative, because gold's going to go up. If we're in a bear market in the NASDAQ, gold's going way up in that bear market. Now, if we don't get a bear market, or if the bear market gets cut short by the Fed, right, which I think is the only way that the NASDAQ's not going into a bear market, and the S&P for that matter, the Russell 2000 is almost there. I mean, we've moved down like 17%, 18%. So the Russell 2000 is going to be the first index to tip into bear market territory. But I think if we don't get the bear market, or we don't get a bear market, where we're down 40, 50%, it's going to be because of the Fed. It's going to be because the Fed comes in and rescues the market with rate cuts and quantitative easing. But if that happens, that's even more bullish for gold than the market's going down. And so even though gold is negatively correlated to the NASDAQ when the NASDAQ is falling, it's going to be positively correlated when it's rising. If it's rising because of rate cuts and QE, especially if inflation is still above target, which it will be. That's going to be the game changer. It's going to be that the Fed is going to be easing when inflation is above its target. That's never happened before, ever since they made up this 2% target. All of their easy money, all their rate cuts and all their QE, they've been able to get away with that under the pretense that, inflation is below target, and so we could do this. They've never done it when inflation is above targets. Now there's no excuse, no pretense. And I think there you're going to get a big drop in the dollar, which we haven't had yet. Yes, the dollar index has been going down, but you're still looking at 104 on the dollar index. It hasn't really dropped very much. We're at 103.7. So we're back below where we were when Trump was elected. So all of the Trump dollar gains have been eradicated. But we haven't really had a weak dollar. If starts cutting, or when the Fed starts cutting and going back to QE, the dollar is going to get killed. And that is an environment where gold's going to shine much brighter. See, the gold's been strong even when the dollar has been relatively strong on foreign exchange markets. But when the dollar gets weak, which it is going to do, I'm convinced that we're going to see a much weaker dollar, then that is going to be very bullish for gold. But I also think, in this shakeout, we could see the whole Bitcoin narrative fall apart, in which case there's no reason for a strategic reserve, and people will realize that. And so we're not going to have it. We're not going to have it on the state level. I think you're going to see all the selling from the ETFs. People will realize, what the hell do I own it for? If it's just digital risk, I get plenty of risk in the stock market. Why do I need it in crypto? If the whole idea was, this is a safe haven store of value. No, that's gold. So if you want gold, you buy gold. You don't buy Bitcoin if you want gold. You buy Bitcoin if you want risk, but you might as well buy something risky that actually has value. You might as well buy a stock that has earnings, or might have earnings, or that pays a dividend rather than that pays nothing.
So let's take this even further, because I want you to really see the setup here. A lot of people are sitting there on Twitter, or X, whatever we're supposed to call it now, cheering on the Nasdaq, high-fiving over Nvidia's trillion-dollar valuation, and telling you that Bitcoin is a new monetary standard that's going to flip gold. And to that I say, okay champ, have you tried looking at history? Because here's the dirty little secret nobody in Silicon Valley or the crypto crowd wants to admit. Every major tech boom in modern history has ended the same way. The 1920s were all about the radio boom and car boom. Stock prices went parabolic. Then came 1929, an 80% wipeout. It didn't really recover, even in nominal terms, until the early 1950s. Then you had the Nifty 50 in the late 60s, companies like Polaroid, Kodak, Xerox that were changing the world. Got crushed in the 70s. Then of course, the dot-com bubble. Pets.com. Global Crossing. Cisco was a $500 billion company, took nearly 20 years to crawl back. And now, we have this latest everything bubble iteration, turbocharged by zero interest rates and trillions in Fed liquidity. And people genuinely believe that tech stocks are a perpetual motion machine, that somehow you can have infinite valuations on top of shrinking margins, funded by corporate buybacks using borrowed money, and nothing ever breaks. Until it does. And the higher up you've climbed on the pyramid of speculative nonsense, from big tech to microcaps to SPACs to joke coins with dog faces on them, the harder you're going to fall. Now contrast that with gold. Through all these booms and busts, through every policy mistake from the Fed, through every war and debt blowout, gold didn't go bankrupt. Gold didn't crash to zero. Gold didn't restate its earnings. Gold didn't do a stock split to manipulate optics. It just sat there, preserving purchasing power for millennia. You know, if gold had a Twitter account, it wouldn't even bother posting memes. It'd just sit there, smirking while fiat currencies and risk assets imploded. Maybe once in a while it would retweet the US national debt clock with the caption, "Told you." And meanwhile, look what's happening in the bond market. That's the elephant in the room. Everyone's acting like long-dated treasuries are still a safe haven. But did you see what happened when yields spiked from 1% to 4.5%? It triggered the biggest bond bear market in history. A 30-year treasury bought at the top in 2020 is down 40% in market value. That's not a safe haven. That's a train wreck. And it's going to get worse because inflation is not going back to 2% sustainably without a massive economic implosion. Something nobody in Washington has the stomach to allow. And that's why central banks are buying gold. They're not dumb. They look at their own books. They know the only way out of this is to inflate the debt away. If you're sitting on trillions of reserves and you realize that the issuing governments plan to monetize their obligations by printing, what do? You swap out of the paper promises into the real thing. Now, let me hammer this silver point again, because I want this to be burned into your brain by the time you finish watching this. We are looking at one of the biggest relative mispricings in history. Gold is up 50% from its 2020 high, making new all-time highs above $3,000. Meanwhile, silver is still stuck around $35, below its 2020 high. Historically, that does not last. And it's not just some technical ratio, though that gold to silver ratio is still up in the stratosphere. It's also about supply dynamics. Silver inventories on COMEX and the LBMA have been declining quarter after quarter. Industrial demand, especially from solar and EVs, is hitting records. Meanwhile, investment demand is still dormant. That's the sweet spot for you as a contrarian. You get to front-run the herd before they wake up and pile in, driving silver exponentially higher. It's basically like being handed a lottery ticket that isn't even hidden. It's laying there in the street, and the average retail investor is too busy chasing the next altcoin to notice. That's why you buy silver now. You buy it when nobody else wants it, when the mainstream financial media is telling you to stick to Nvidia, or ARKK, or Bitcoin. Because by the time silver is the lead story on CNBC, by the time Jim Cramer is telling you to buy silver miners, it's already priced in. You want to be the guy selling to them, not the sucker buying from them. And here's the other dirty little reality about crypto. For all the nonsense about it being digital gold, when push comes to shove in a liquidity crisis, crypto trades like a leveraged tech stock. It's basically ARKK with extra steps. You saw that in March 2020. You saw it again in 2022 when Bitcoin went from $68,000 to $15,000. And you'll see it again in the next bear market. If the Nasdaq drops 50%, which is perfectly normal historically, Bitcoin is not going to decorrelate. It's going to crater even harder. That's why you see Michael Saylor constantly tweeting laser eyes and shodel memes. Because deep down, he knows that if Bitcoin ever went back below his average buy price, MicroStrategy's balance sheet would implode. It's a leveraged bet. It's not a monetary safe haven. Meanwhile, look at what's starting to happen politically. You've got Trump back, promising all kinds of spending. The big, beautiful infrastructure bills, the tariffs, the subsidies. This is not some magical pro-growth miracle. This is more deficit spending. More debt layered on top of already unsustainable obligations. And if you think the Fed can keep hiking rates to fight inflation in that environment, I've got a bridge in Brooklyn to sell you. At some point, the math breaks. The Treasury will have to roll trillions in debt at much higher rates. Interest expense will crowd out everything else. You're already seeing it. Interest on the debt is now larger than the defense budget. Soon, it will be bigger than Social Security. The only politically palatable solution is to have the Fed monetize it. In other words, print. And when that becomes obvious to markets, the dollar is going to tank, and gold and silver are going to explode. And it's not just a US story. Globally, you have a seismic realignment happening. China is opening vaults in Hong Kong and Saudi Arabia. They want to clear oil and commodities in yuan and settle in gold, not dollars. The BRICS nations are openly discussing alternative reserve structures. Meanwhile, US policymakers are weaponizing the dollar system with sanctions, driving more and more countries to look for alternatives. That's why you're seeing these big moves by the Shanghai Gold Exchange. They're opening up to foreign participation. They're setting up to become the global price setter in gold, eventually wresting that power from London and New York. Because they see what's coming. They're playing chess, while Washington is busy arguing over gender pronouns and what kind of rainbow they can put on the next fighter jet. I mean, look, you don't have to be a geopolitical genius to see how this ends. If you're Saudi Arabia, why would you keep 80% of your reserves in dollars when the US could freeze your assets at the stroke of a pen? You wouldn't. You'd diversify into gold. If you're China, sitting on $1 trillion US treasuries that are losing real value every year, why wouldn't you accelerate plans to build a yuan plus gold settlement system? That's exactly what they're doing. The writing is on the wall. Now let's go back to the personal investor level. Everyone likes to talk about what the kids are buying. The kids are buying Bitcoin. Well, here's the thing. Kids grow up. And when they do, they usually learn the hard way what money actually is. Gold has 5,000 years of history. Bitcoin has 15 years, and most of that was spent getting manipulated by exchanges like FTX that turned out to be giant scams. You know what they don't teach in Bitcoin conferences? The concept of monetary evolution. Every fiat currency ever created has gone to zero. Every single one. The Roman denarius, the French livre, the Weimar mark, the Zimbabwe dollar, the Venezuelan bolivar. And it happens gradually, then suddenly. The only constant across millennia is gold. There's a reason central banks don't have reserves in Dogecoin. And speaking of insiders, remember, central bankers buying gold is like insiders selling on their own monetary system. They are quietly hedging against the very policies they're enacting. That's why they're net buyers of gold for 14 straight years. They know how this ends. Meanwhile, the average American is maxing out his credit cards at 22% interest to buy stuff from Amazon he doesn't need. You think that's sustainable? We've got record household debt, record corporate debt, record sovereign debt, and people wonder why I pound the table on gold and silver. Because look, at the end of the day, this isn't complicated. When you print trillions of dollars out of thin air, each individual dollar becomes worth less. Not worthless yet, but worth less. It's basic supply and demand. More dollars chasing the same goods means higher prices. And the only way to protect yourself from that is to own real assets. Tangible assets. Gold. Silver. Things with no counterparty risk. You know what has counterparty risk? $1 in the bank. Because it's only worth what the Fed says it is. You know what else has counterparty risk? A stock certificate. Because the company can go bankrupt. Even your local real estate can have counterparty risk. Ask landlords in cities that have imposed rent moratoriums or restrictions. Gold doesn't need a promise. It just sits there. Nobody else's liability. And silver? Silver's even better right now because it's historically cheap relative to gold. The gold-silver ratio is still around 80-1, when it's averaged closer to 50 over the past century. During bull runs, it typically collapses to 30 or even 20. That means silver has 2 to 3 times upside relative to gold just to normalize. So here's your game plan. You front-run the inevitable. You load up on physical gold and silver. Not paper ETFs that can be cash settled with no delivery. You want the real thing in your hands, or at least in a vault you control. And if you've got some speculation capital, fine, buy some mining stocks. Buy some silver juniors. Because when this thing breaks, they're going to be the moonshots. Meanwhile, let the Bitcoin maximalists keep tweeting their laser eyes. When the next liquidity crisis hits, they'll find out the hard way that Bitcoin is a risk-on asset, not digital gold. And when the Fed has to pivot, the dollar gets clobbered. Inflation rips higher. Gold and silver will be there to pick up the monetary slack. So don't wait for CNBC to tell you it's time to buy. By then, it'll be too late. Do what the insiders are doing. Follow the central banks. Ignore the kids on TikTok. Get yourself some real money while it's still absurdly cheap. And hey, if nothing else, next time you're at a cocktail party and someone's bragging about their crypto gains, you can smile and think to yourself, yeah, let's see where we all stand in 5 years. Because markets have a funny way of teaching lessons, often painfully and always on their own schedule. So that's it. If you want to protect yourself from what's coming, gold and silver aren't just good trades, they're survival trades. Don't say you weren't warned.